So, hello students, how are you all doing? I'm sure you are doing fantastic. Students, we are headed on to chapter 9, unit 5. Okay. Before I talk about chapter 9, unit 5, some elements of unit 4, I would like to recap with you so that things are crystal clear. In unit 4, what really matters is your understanding of the terms, how three exchange rates are decided, right? So in flexible exchange rate system, exchange rate are decided by the market forces of demand and supply, right? Through the market forces of demand and supply. In managed float, some government intervention plus some market force. This is what prevails in most of the countries, including India. Fixed exchange rate system is the rate where government decides the exchange rate. Okay, this is what we had studied. Finally, students, we are on to chapter 9, unit 5. Okay, finally, we are on to chapter 9, unit 5. Students, just a second. Yes. So, students, the first thing is in chapter 9, unit 5, we have to understand a couple of terms, FDI and FPI. There are many terms that we will understand, but these are two important terms. Before I tell these two terms, why are international capital movements needed? What is international capital movement? A lot of questions I have left you with. See, money moves in from one country to another country, correct? Capital flows from one boundary to other boundary, right? So capital moves across borders just like goods and services. Capital means money moves across border just like goods and services. Why? Because we are living in an open economy where goods and services are both imported and exported. Just like goods and services, foreigners invest in our country, we invest in their country. So, how many types of foreign capital are there? Class, primarily four. Number one is a foreign aid. Aid means a help. You are not expecting anything in return. I'll give you an example, students. Approximately in 2015, Nepal had a severe earthquake. India sent in a lot of aid, help for the re-establishment of Nepal because it was humongous. The loss was humongous. That is aid. So type of foreign capital number one is foreign aid, where to help that person money goes. Second, borrowings. It is a setup, students, in which loans are taken from government, IMF, World Bank, trade credit, external commercial borrowings, etc. Loans are taken. These are borrowings. Then we have NRI deposits. Class, what is NRI deposits? NRI deposits means a Indian person working abroad who has got a job abroad, maybe, who has got a business abroad, maybe, whatever it is, they deposit some money in India, correct? That is NRI deposits. So I've spoken about foreign aid, I've spoken about borrowings, I've spoken about NRI deposits. Then, class, your ultimate topic, foreign investments. The two terms, foreign direct investment and foreign portfolio investment. Students, remember one thing. When the intention of the foreign investor is active participation, active long-term control and ownership of Indian business. So when the goal is to play an active role there, we call it FDI, foreign direct investment. And what is FPI? Foreign portfolio investment. It is, students, passive and short term in nature. I will explain that. Don't worry, I will explain that. Both of these points I will explain, right? So in FDI, what happens is, students, suppose I give the example, let's see Bill Gates. So Bill Gates invests money in India. Okay. Bill Gates puts some money in India. When he's doing so, he's setting up a Microsoft office in India. So he's buying land, he's buying a building, he's hiring staff. So it is an active investment, it is an active involvement. Here, the goal is long term control and ownership of Microsoft. He's not just buying Microsoft just to sell it 3 months later at a higher price. But what is foreign portfolio investment? When the foreign investor who is coming into your business have an active intention, they invest in your country with a passive short-term strategy. With a passive short-term strategy. Their idea is not active business management. They are not concerned with what your business is doing in detail. What they are interested in is basically, I will explain you students, that they heard good news about you. Warren Buffett comes to hear that Reliance share prices are going to go up. Reliance Industries share prices are going to go up. Warren Buffett thinks that it is a great time to seize this opportunity. What he does is he buys some shares of Reliance just with the intention of selling it at a later date at a much higher price. So, is he really interested in the day to day operations of Reliance? No. He just wants Reliance to do well in the sense that the share prices go in his favor. Foreign portfolio investment. It is a passive investment strategy with a short term involvement, with a short term involvement class. The important thing is here the ownership stake of the foreign investor in foreign portfolio investment, dear students, will be less than 10%. A very important data to remember. In foreign portfolio investment, the investor's ownership stake would be less than 10%. But friends, when we talk about direct investment, the investment stake is 10% or greater. 10% or greater. Of course, there are different types of FDI, but it is imperative that we know what FDI is first of all. Okay? So to sum it up everything, to sum it up, we have studied that there are four types of foreign capital: foreign aid, borrowings, NRI deposits, and foreign investments. Foreign investments are of two types: FDI and FPI. Good. Now moving on. What is FDI? As I have already told you, let's read it out. Investment with the ownership and control by a foreign investor, by a foreign investor in domestic enterprises, by a foreign investor in domestic enterprises, ownership of 10% or greater, ownership of 10% or greater, right sir? Ownership of 10% or greater. Now class, if we move forward from here, there are different types of FDI. Horizontal FDI. I was telling you na, Bill Gates is operating Microsoft US, okay? Microsoft America. Now, Microsoft is basically providing the programming service, right? The software service. They set up Microsoft India. So tell me, friends, this Microsoft that they have invested, this Microsoft, the fact that they have they invested in a completely new business or in the same business in a different country? Same business in a different country. Then you call it horizontal FDI. Type number one is horizontal FDI. Now we understand, sir. You all of you know, class. There's an Indian brand called Ola Cabs. All of you know about Ola Cabs. Now, if Ola Cabs start operating in America, start operating in UK, they are already in most of the many countries. So if they start operating in US, the UK, and everything else, they are doing cab service only there also. They are not, entering into something different. That's horizontal FDI. That's horizontal FDI. Next, we have vertical FDI. Now that's interesting, friends. What is this vertical FDI? That's interesting, friends. Vertical FDI means some part of the process you are investing in. Let me give you an example, okay? Let's say there is a car manufacturing company in Sweden. Sweden, okay? There is a car manufacturing company in Sweden. Now, this car manufacturing company, naturally, they don't have their own tires. So they acquire tires from some other company. They acquire seed bags from some other company. They acquire airbags from some other company. Correct? Okay. This car manufacturing company, in Sweden, find out a great opportunity in India, friends. They find out a great opportunity in India, friends. In India, in India, what they find out is, class in India, what they find out is there is a company that manufacture tires. This Swedish company thinks that tires we have to buy at a higher price. What if we acquire this business in India? What we acquire, what we set up MRF tires in India? What if we set up MRF tires in India? Because India has low cost labor available. So they invest in tires in India. Thinking carefully, you will see it is a part of their car business, yes or no? That is called vertical integration or vertical investment. A part of the process in your entire journey, you are investing in that. Instead of a same business, you are investing it in a vertical business. Because before the car is made, the tire is made. So they are investing in tires. A part of the process, entire pipeline, a part of the entire pipeline. That is vertical. What is conglomerate? That's interesting, friends. Conglomerate FDI. Students, conglomerate FDI means when you invest in a completely unrelated business. When you invest in a completely unrelated business that is nothing to do with your main business, completely unrelated. Sir, we did not understand. Let's say the car manufacturing company, the Swedish company, invests in, okay, this car manufacturing company invests in food business in India. Has car to do anything with food? No, it's a completely unrelated business. Or let's say this car company starts making tobacco or selling tobacco in India. Or maybe an alcohol business. Whatever example strikes your mind. Is there any relation with the car business? No. When the foreign participant invests in a country in a completely new genre in which it was not previously existent, then dear students, we get a conglomerate FDI. Understood, sir. Understood. And finally, we get into the world of two-way FDI. Friends, what is this two-way FDI? Please give me an opportunity to explain this. What is this two-way FDI? Say India invests in US, US invests in India. So I will invest in some portion of your country, you invest in some portion of my country. That's two-way FDI. So say Japan and America strike into an agreement. Japan is known for its cars. Let's say America is known for its computers. So America invests in computers in Japan and set up a computer division in Japan. Japan sets up a car division in America. Both are investing in each other's country in their respective strengths. Understood, sir. Understood, sir. Now, foreign portfolio investment. Students, here the main intention is to own the financial capital of the other party. To own the financial capital of the other party. Financial capital means shares, debentures, stuff like these. Shares, debentures, stuff like this. That is financial capital. This is what is written here, stocks and bonds. It's speculative in nature and volatile in nature, because here you are investing because you feel that the value of the price, value of the share will go up. That is the intention. So generally they own less than 10%, and it is easily withdrawable. One can easily sell. So let's say Warren Buffett acquires shares of Reliance. He can easily sell it the next day only. Not even 3 days needed. So students, finally, I want you to read this differences between FDI and FPI. I have explained all. I just want you to witness it for a minute or two. Just for a minute. Please look into that. Let's see. So here we go, class. In FDI, the investment is in real assets. In FPI, the investment is in financial asset. That is shares and bonds. Right? In FDI, there is a control. In FPI, there is no control. That is, you don't get a control over the company. Right? Risk is lower in FDI. You know why? Because you are investing in long term. Remember, students, anything you opt for in long term, the risk will be reduced. I will give you an example. I was planning to buy some SIP, okay, some mutual funds, okay, a very small amount. I was planning. So I did it 2 years back. Small. You know how small? 1,000 per month means the lowest possible amount. Just I wanted to see how it works. So if 2 years back I put in my money, so it's basically 12, approximately 24,000 or 25,000 gone. It's still going in. So the amount became 26,000, meaning I have invested 25,000, amount is 26,000. So over 2 years, 2.5 years, I have only earned 1,000. This is what I thought. Gradually, I realized that this is a short term. In SIP or investment, if you see, 10 years is a good period to judge any investment. That is what FDI is all about. Here you buy assets, here you buy a building, here you hire your management. They will need time to set up the business, to set up operations, to start selling the product, to start approaching the clients. All of these take their own time. So the risk is lower here, risk is higher here. Risk is lower and risk is higher. Okay. Exit. In FDI, exit is very difficult because your stakes are too high. You have invested a lot. Here it's easy. They think that the share is not doing well, they will exit. Sell it for a shorter price, maybe. Okay. Now, reasons for FDI. Class, reasons for FDI. Why should somebody invest for a longer term? They expect higher returns. They expect global expansion. They expect cost reduction. A very good example of cost reduction that strikes my mind is Pepsi and Coca Cola. I always give this example. Students, Pepsi or Coca Cola, let's say Coca Cola, they are present in more than 100 countries. So a 1 liter bottle that they sell you at rupee 60, it costs them 1 liter bottle at rupee 1. Imagine the scale of operations. Imagine the quantity in which they are operating. Imagine the quantity in which they are operating. Another reason people enter into FDI is access to resources. You see, India has good labor resource. The world, by investing in India, can access this talented resource. Similarly, if India invests in, let's say, Sweden or any other European country, India will be able to take advantage of the technology. Next, reasons for FDI: lower regulations, labor costs abroad. See, you see, many of our Indians are investing or doing their work in Dubai, in the Middle East. You know why? Because they say the rules are very lenient there in terms of how easily you can start your own work. Political stability and tax benefits are also some of the reasons people undertake FDI. Now, how do you open FDI? How do you set up your own FDI? FDI is foreign direct investment. All of us understand this, right? So, how do you set up your own FDI unit? Students, it's very easy. It's very easy. You can have a subsidiary. You own a subsidiary when you own majority of the shares of the company, or you control majority of the directors of the company. That is subsidiary. When you have a control over majority of shares of that company or majority of directors of that company. Joint ventures, you understood. Like for example, a very famous joint venture was Hero Honda, Maruti Suzuki. So India and Japan, they came together with their respective strengths, joint venture. Then there are two kinds of investments which institute often asks. So I will explain both of them: the greenfield investment and the brownfield investment. What did you say, sir? The greenfield investment and the brownfield investment. What is this greenfield investment, students? When the foreign investor invests in your country and starts everything from scratch. Say a foreign participant wants to set up an airport. They buy the land, they create the infrastructure, they hire the staff, everything new setup. That is greenfield investment. What is brownfield investment? Means the airport was already there. The foreign investor has just acquired that airport. So resources and everything was already there. You just acquired that asset. Game over. That's brownfield investment. Then you have mergers and acquisitions, two companies merging and becoming one. That is mergers and acquisitions, right? And equity injection. You buy shares of that company. So students, today India is among the top 10 FDI destinations globally. Major sectors in India that receive FDIs: IT sector, telecom, auto and pharma sector. India itself is investing abroad, right? Companies like Tata, Wipro, Reliance, ONGC have their projects going on in UK, US, in the oil fields, and so on and so forth. Right? Let's this was the chapter 9, unit 5. Students, yes, we are going to practice the MCQs. First, let's look at a glance one more time before I move forward with the new discussion. So we have discussed what is FDI. It is a process through which resident of one country acquires ownership, control and management of assets in other country. ठीक है? Components of FDI, you have your equity capital, you have your reinvested earnings, and you have other direct capital. So equity is there, reinvested earnings in there, and other direct capital is there. FDI stake is 10% or more. Here it's below 10%. Types we have studied: horizontal, vertical, and conglomerate. Remember the two terms in modes of FDI: greenfield investment, where there is a creation of a completely new asset or a facility, and in brownfield investment, there is a existing infrastructure that is being invested in. FDI in India, inbound FDI. So if I talk about the money that has come into India, major source of non-debt financial resource for economic development, India recorded FDI inflows of around $82,000 million in the, that is 10% higher than the previous year. Major sectors in India that benefited were service sector, IT, telecom, automobile, pharma. Where did India get the most amount of investment from? Mauritius. If it comes in MCQ, from Mauritius, followed by Singapore, US, Netherlands, and Japan. Where did the money come from? The top source of investment. Mauritius, followed by Singapore, USA, Netherlands, and Japan. Then we talk about outbound FDI. Here, Indian firms are investing abroad to access markets, resources, technology, and strategic assets. It helps in global expansion, diversification, and competitiveness. Example: Tata Group, Reliance, Dr. Reddy, Ola, they have invested outside. Right, sir. Students, some MCQs, it would be great if we practice them, right? Both from Unit 4 and Unit 5, I am doing the MCQ with you so that we get a recap of both them. ठीक है, both of them. Which of the following best defines the real exchange rate system? What is the real exchange rate? You all know it is the nominal rate, number one, adjusted with inflation, and number two is that compares the relative price of two goods, right? Like I gave the example, one USA computer was 1.25 Indian computers. You remember that day? Right. The market rate for converting one currency into another. Students, market rate is called nominal exchange rate. What is it called? Nomin. Suppose I want to buy $1 today. I have to pay 95 rupees. That is nominal exchange rate. But price of one commodity in US is equals to how many goods in India of the same commodity? That's a real exchange rate. The rate at which a country trades goods or services for another. Right. In fact, I give this example of laptop, right? 1,80,000. Now, class, a very important question. If nominal exchange rate is 75 rupees, okay? 75 rupee per dollar, okay? Indian price is 150 and US price is 100. So if US price is 100, US price is 100, to convert it into rupee, we multiply 100. And Indian price is how much, class? 150. But wait, students, wait here. When you do this computation, of course you are getting 50, right? 50. So that is there. But as per institute's material, you would do what? 75 per dollar into, always remember, into Indian CPI you will keep above. Means Indian price of good and US price you will keep at the bottom. This is what has been written in ICAI material. We will follow that. So 112.5 is what your answer is. 112.5. So write it down. Write it down. Real exchange rate equals to nominal exchange rate. I will show it even. Just a minute. If institute's material is here open, then I would show it to you. Just a moment, class. I just want to show it to you so that you don't get confused in exam. Hold on, please. Here it is. Okay, this is unit 5, na? I am talking about unit 4. Here it goes. I told you, na? Real exchange rate is nominal exchange rate into domestic price by foreign price. Into domestic price by foreign price. Real exchange rate is nominal exchange rate. Domestic price means Indian price by foreign price of that same commodity. Okay. Coming back to the discussion. Now, a rise in the real exchange rate indicates what? We have discussed it, class. We have discussed it in great details. Here it is. In the last class only we discussed it. I just want to show you the source so that every time we discuss, there is a revision going on. Yes, you see here. A lower real exchange rate discourages imports. So if rate of real exchange rate falls, imports also fall. And if real exchange rate rises, imports also rises. So real exchange rate and imports are directly related. You should write it down, class. Real exchange rate, you are getting a good chance to recap everything. Real exchange rate and imports, friends, are directly related. A rise in one leads to the rise in another. A fall in one leads to fall in another. In this context, let me bring you to the MCQs that we are discussing. So a rise in real exchange rate indicates domestic goods are costlier than foreign goods. Yes, that is why imports will rise because domestic goods are costlier. That is what I taught you. A rise in real exchange rate means imports will rise. Why does imports rise? Because foreign goods are cheaper. That is what is written. Domestic goods are costlier. Got it, sir. A good question. A fall in India's nominal exchange rate. It means what? Suppose we were at rupees 80 per dollar. Fall in exchange rate means it has become rupee 100 per dollar. It means the value of rupee has fallen and the value of dollar has increased. So depreciation of rupee. So depreciation of rupee and appreciation of dollar. Both are happening. When fall in India's nominal exchange rate means rupee 80 per dollar has become rupee 100 per dollar. So dollar's value has increased, rupee's value has decreased. So D is the correct answer. Both B and C. Which of the following is a disadvantage of floating exchange rate system? You remember what is floating exchange rate system? Where exchange rate is decided by who? By the market forces of demand and supply. But whenever you leave everything to demand and supply, there will be volatility. There will be wide fluctuations. So currency fluctuations create trade uncertainty. Today, it may be rupees 80 per dollar. So you may feel that, okay, rupee value has improved. So let's start selling. Another day, it may become rupee 100 per dollar, or it may become rupee 70 per dollar. So whatever you decision you take today, because of instability, because of market fluctuations, you would never know what will happen the next day. And nobody trades in uncertainty. Some uncertainty is there, but so much of uncertainty under the fixed exchange rate system. The name itself says fixed exchange rate system. Who participates here? Government. The goal is to avoid wide fluctuations in the exchange rate, to avoid wide fluctuations in the exchange rate. So the government keeps the exchange rate unchanged. The government keeps the exchange rate unchanged. What is forward exchange rate? What is forward exchange rate? Used for immediate transactions, spot market price, agreed exchange rate for future delivery, always equal to nominal rate. What is forward exchange rate? I gave this example. We agreed today, but when is the transaction taking place? In the future. I gave that importer's example. You remember? An Indian importer wants to buy from US in the last class. Agreed exchange rate for future delivery. When rupee appreciates against the dollar, the likely result is, oh my God, now the value of rupee is increasing. Now the value of rupee is increasing. So if rupee value is increasing, then imports are becoming cheaper. So people will start importing. So remember this, friends. Acha, you want to see the example here? Let me give you the example here. Suppose rupee 80 per dollar. Okay. Let me explain this through an example one more time. Suppose it's rupee 80 per dollar. Any product in India is worth rupees, say 80,000. Okay. Price of a commodity in India is rupees 80,000. Okay, sir. No harm done. Now, if you were to witness that rupee 80 per dollar changes to rupee 100 per dollar, think from the foreigner's perspective. Okay. If the foreigner wants to buy these goods of rupees 80,000, they will have to give how many dollars? 80,000 by 80. So for them, for the foreigner, the price is how many dollars? $1,000. Right? $1,000. Think carefully. I'm talking about that foreigner now, foreign product now. Now, if rupee 80 per dollar becomes rupee 100 per dollar, this is fall in rupee. This is fall in rupee. They have asked rupee appreciates. So let me make it 50 per dollar. Okay. So if it's 50 per dollar, for that same foreign person, 80,000 rupee by 50, the price has gone to how many dollars? $1,600. Why? Because rupee became expensive. So for that same 80,000 rupee product, for same 80,000 rupee product, you see the goods have become costlier now. So naturally, India's exports will fall and imports will rise. That is what I've written. Imports become cheaper. Which of the following affects real exchange rate directly? Domestic and foreign price levels. Domestic and foreign price levels. You have forgotten the formula or what? What was the formula of real exchange rate? Nominal exchange rate into domestic price by foreign price. So both domestic and foreign price are there in the formula. What is real effective exchange rate? It is nominal effective exchange rate adjusted for inflation. Then you get real effective exchange rate. That is called real effective exchange rate. Now, the topic that we did today, Unit 5, questions from there. This was all Unit 4 questions. Now, Unit 5 questions. Which of the following is not a form of foreign capital? Not a foreign capital. We discussed four. Do you remember the four types? Sir, you taught us about foreign aid. You talked about investments, both FDI and FPI. You can see it here. I can show it to you even. It's there in the notes. Foreign aid, borrowings by the governments, NRI deposits, and foreign investments. Okay. So if you look carefully, class, there is domestic subsidies here. So domestic subsidies is the odd one out. Foreign aid is coming from foreign, FDI, FPI are from foreign. Only subsidy is domestic. FDI is distinguished from FPI mainly because how is FDI different from FPI? Look at the points. Look at the points, then answer. Then answer me, class. Why is FDI different from FPI? FDI is short term. Absolutely wrong. FDI is long term. FDI is only financial wrong. FDI involves ownership and control. Ha. Which of the following is a vertical FDI? Vertical FDI means not the same business, but in the same line of business, you are there. I give the example of car, tire. Let's see. Car company investing in another car company. What is it? It's horizontal FDI. Car company acquiring tire manufacturer abroad. Vertical. Oil company starting an unrelated business. Conglomerate. I explained the other types as well. Conglomerate. Easy one. A foreign investor owning less than 10% equity in an Indian company. A foreign investor owning less than 10% equity, dear students. Less than 10% equity, students. What would you call it? FPI, foreign portfolio investment. Which of the following is a feature of FPI? Long term commitment, technology transfer, management participation, easy withdrawal. Yes, you can sell your shares anytime you want. Easy withdrawal is a unique feature. Which of the following is not a benefit of FDI? जो FDI का benefit नहीं है. Think and answer, class. Is it employment generation? I don't think so. Technology upgrade, foreign exchange, trade barriers. Not a benefit of FDI. See, creating trade barriers. Why will it create trade barriers? FDI is opening trade barriers. You are investing the money. So how is it creating trade barriers? It is promoting trade, in fact. Huh. Now the government wants FDI to come into India. So government kinds of gives away a lot of incentives to the outsiders. Which of the following is not an incentive to encourage investment? FDI is encouraged in India through all except tax holiday, ease of doing business, protectionist import ban, or SEZ? The correct answer is protectionist import bans. Protectionist import bans. Which of the following is a risk of heavy FDI dependence? In which of these you will see heavy FDI dependence, heavy foreign direct investment dependence, higher inflation, sovereignty loss, rupee appreciation, lower technology? Which of the following is a risk of heavy FDI dependence? If you think carefully, loss of sovereignty. When the foreign investor in your country becomes too powerful, they are going to start making decisions for your country. They are going to start interfering with the political class. Sovereignty loss. Why is FDI considered more stable than FPI? Because it has no exchange risk, it is illiquid, it is interest bearing, or it involves long term productive investment. See, it is stable because it is long term. Brownfield investment refers to what? Building new infrastructure, that is greenfield investment. Investing in agriculture, buying or leasing existing setup. I give the example of airport. An airport is already running. You just lease it. So with this, students, your chapter 9 is finally complete. Now, students, where are we headed next? Class, as per your institute's guidelines, we are now supposed to do, we have completed chapter 9. It's interesting, but today and the next class, institute has dedicated for national income. So what we are going to discuss is national income. That is chapter 6 here. All right. It's a huge unit. We will discuss the most relevant of the items. Right. Okay. So hello students. Now we are starting with national income accounting. The first question that could be asked before I talk much about national income accounting, who are the pioneers? Who should get the credit of developing national income accounting? These are the two economist students, Simon Kuznets and Richard Stone. Very important for your MCQ paper. Simon Kuznets and Richard Stone. What is national income accounting? Calculation of national income is called national income accounting. What is national income accounting? Calculation of national income is called national income accounting. Now, what does national income accounting record? It records flows from production to consumption. How resources flow from production to consumption. Got it, sir? Got it, sir? Right, sir. It records flows from production to consumption. How is it used? Students, it's used by policymakers, it's used by businesses and economists to assess and forecast the economy. Two, used by policymakers, businesses, economists to assess and forecast the economy. Let's try to understand the practical world now. These were all the theoretical things. Are you ready, class? Yes, sir. Students, you can just draw this diagram with me. In exam, nobody is asking for diagram. I am just explaining the concept, so I'm drawing it. Okay. All right. Sorry. Students, this is India. Okay. This is our India. This is rest of the world. So India, hold on. India and ROW, rest of the world. Friends, in India, there are two kinds of people buying goods and services. In rest of the world also, there are two kinds of people who are buying goods and services. In India, there are two kinds of people who are buying goods and services. In rest of the world also the same case. Who are the two kinds of people? Who are the two kinds of people? In India, there are two kinds of people who are earning income. In rest of the world also, there are two kinds of people who are earning income. A, in India, there are Indians who are earning. In India, there are Indians who are earning. So IEI, Indians earning in India. B, you have foreigners earning in India. Indians earning in India and foreigners earning in India. Correct? Right, sir. In the rest of the world, students, there are two kinds of people. In the rest of the world also, there are two kinds of people. Indians earning outside India, that is Indians earning abroad, and you have foreigners earning abroad. D, FEA, foreigners earning abroad. Written? Now, first of all, students, I will be using a term, product. You should remember, whenever I say the word product, you should use it interchangeably with the word income. Product and income can be used interchangeably. Why so, sir? Okay. Students, there is a pen in my hand. You can see this. Okay. Suppose I am the seller of this pen. A student is telling me, sir, I want this pen. I said, okay, take 5,000 rupees. I said 5,000 rupees. Student offered me 5,000 rupees. So the value of this product is how much? 5,000. My income is how much? 5,000. So product is nothing but income. The value of goods and services is nothing but income. सर बात तो समझ में आती है आपने जो बोला. सर ये बात तो हम लोग समझ गए. We definitely did understand this, sir. Now, whatever money is earned within the domestic boundaries of India, I should say it in a better way, whatever value of goods and services are produced within the domestic boundaries of India, that is called domestic product. So domestic product is A plus B. Domestic product is A plus B. So what is important is whatever value of goods and services are produced within the domestic boundaries of the country. So the goods may be produced by Indian in India or the goods may be produced by foreigner in India. Is it in India? Yes. Game over. It's domestic product. It's domestic product. The important emphasis has been laid down on the goods and services being produced where? Within the domestic boundaries of our country, India. And what is national product, my lovely friends? Here, the focus is on normal residents of the country. It is the value of goods and services produced not within the domestic boundaries, but produced by the normal residents of a country during a particular year. So it's not A plus B. It's A plus C. There you have it. So domestic product is A plus B. National product is A plus C. So there are two terms I have told you interchangeably. Both are very important. So domestic product is A plus B and national product is A plus C. It is the value of goods and services produced within the domestic boundaries of a country, and national product is value of goods and services produced by the normal residents of a country. Did you see my language? Yes, sir. So whenever the domestic product word is given, it should be goods and services within the domestic boundary. You should write it down. Domestic boundary. And in national product, the focus is on value of goods and services produced by the normal residents. Now, students, an important question for the numerical perspective is, if you are already a domestic product, friends, and you want to reach here, that is national product, how do you do so? How do you reach from domestic product to national product? So, class, in order to reach from domestic product to national product, what you do is you add up NFIA. So domestic product plus NFIA is equals to national product. Domestic product plus NFIA equals to national product. Students, there is another thing I want you to understand. This domestic product or national product is representing what? Value of goods and services. Now, goods and services can be particularly goods, can be with depreciation or without depreciation. For example, I have produced machine in my country of rupees 5 lakh. Now, this is the gross value of the machine. If I deduct depreciation of this year, the value of the machine is 4 lakh only. So whether I am adding 5 lakh or 4 lakh to the national income, if I am adding 4 lakh, it is gross. If I'm adding 4 lakh, it's net. If I'm adding 5 lakh, it's gross. Gross is including depreciation. When the value of goods and services are measured including depreciation. And when depreciation is deducted, it is net. So remember one second formula, gross minus depreciation is equals to net. Gross minus depreciation is equals to net. Gross minus dep is net. Third thing is, so first was DP plus NFIA is NP. Second one was gross minus dep is net. Third one is factory price. See, students, this is my factory. The good is ready for 500. But suppose government imposes 200 rupees tax. So the market price becomes 700. Similarly, I have another good on which 600 is the factory price. But this is an essential commodity. So government gives me a subsidy of 100 rupee. So market price becomes how much? 500. So just because product is ready in the factory at a certain price, does it mean it will be sold in the market at that price? No. If indirect tax is imposed, the price will increase. And if subsidy has been granted, the price will reduce. So long story short, factory price plus net indirect taxes is equals to market price. What is net indirect tax? It's indirect taxes minus subsidies. It's indirect taxes minus subsidies. Now, class, another area of discussion. When they have given you NFIA, NFIA class, I had circled it in red for later discussion. Class, NFIA has two meanings. First meaning, net factor income from abroad, net factor income to abroad. What do you mean, sir? From abroad and to abroad? See, it has two meanings, class. From means, suppose our Indians who are earning abroad, my friends, suppose our Indians who are earning abroad are earning 500 rupees, are earning 500 rupees. Indians earning abroad are earning 500 rupees, and the foreigners earning in India are earning 200 rupees. So overall money is coming in because Indians are earning abroad 500 and foreigners are earning in India 200. So India is net 1000, net 300 positive, 500 minus 200, right? So when NFIA is positive, the word from is used. From means Indians earning abroad is greater than foreigners earning in India. Two is foreigners earning in India is greater than Indians earning abroad. Is greater than Indians earning abroad. Right, sir. All of us have understood this, sir. So there we go. So in NFIA, if it is from, it means Indian earning abroad is greater than foreigners earning in India. And if it's two, foreigners earning in India is greater than Indians earning abroad. Game over. Game over. So, sir, NFIA is also clear to us, all of us. 3 points have been done, class. Now, do you know you have studied 8 aggregates? Sir, how so? You can write it down along with me. 8 aggregates. Number one is GDP at MP. Number two is GDP at FC. Number three is NDP at FC. Number four is NDP at FC. Five is GNP at MP. Six is GNP at FC. Seventh is NNP at MP. Eighth is NNP at FC. Eighth is NNP at FC. These are the 8 aggregates. These are the 8 aggregates of national income. Do you know which is the default one? NNP at FC. So students, if question is silent and asks you to compute national income, remember you find out NNP at FC. So write down default. Write down default. Default. NNP at FC is equal to national income. This is the default. NNP at FC is equals to national income. Okay? Right, sir. So, a couple of questions. Let's practice them before we indulge into a much more detailed discussion. Okay? Let's do that now. Let's do that now. Write a question. GDP at MP is rupee 1000. Every figure is in crores. Okay? So I'm not writing crores, and all this stuff again and again. Capital consumption allowance. Let it be very clear, class. Capital consumption allowance means depreciation. It's given to us as rupees 20. Indirect tax is 30. Subsidy is 10. Net factor income to abroad is 200. Net factor income to abroad is 200. They have asked you to compute number one, national income, number two, GNP at FC, number three, NDP at MP. All data has been given to you all. Three things you have to calculate, class. I am waiting. I'll wait for a couple of minutes before I just solve it for you. Come on, class. So here I go, class. Friends, here I solve it now. 2 minutes are over. National income is, dear students, NNP at FC. So let me help you out. Let me teach you the trick how to come out of all these kind of questions. A very easy trick indeed. See, whatever you have to find, national income means NNP at FC, you put it on the right. Class, you put it on the right. जो भी निकालना है, you put it on the right. Huh? Whatever is given is GDP at MP, you put it on the left. You put it on the left. Now, from gross, if you want net, what do you do? To reach from gross to net, what do you do? Deduct depreciation. Deduct depreciation. So from gross to net, you deduct depreciation. Friends, gross to net depreciation gone. Yes or no, friends? Next is what, class? From domestic product, if you want to reach a national product, what do? You add NFIA. You add NFIA. Next is what, class? Pay attention, friends. Next is what? You add NFIA. Now from market price, you want to reach factory price. Now from market price, if you reach factory price, what you do? You just deduct net indirect taxes. You deduct net indirect taxes. From market price to reach factory cost, you just deduct net indirect taxes. Friends, if you do so, you have arrived at your win. GDP at MP is 1000. Capital consumption allowance is 20. That is depreciation. NFIA, I tricked you all. NFIA add, but it is written to abroad. So it's not positive 200, it's minus 200. I told you, na, whenever it's given 2, it's positive or a negative. It's a negative. So I will add, of course, it's a plus sign, but not plus 200, minus 200 I will add. And net indirect tax. What is net indirect tax? Indirect tax minus subsidy. So here 30 minus 10 happens to be 20. So here it is 20. And there you go. So 1000 minus 20 is 980, minus 200 is 780, minus 20 is 760 apparently. So NNP at FC is 760 apparently, that is the national income. That is the national income. I hope all of us have copied it or solved it. Right, sir. So, sir, numericals do come. Definitely. I am not doing it for fun. Now, NNP at FC is 760. Class NNP at FC we know is 760. Where do we want to reach next? GNP at FC. Put it here. GNP at FC. If you want to reach here, students see FC, FC, no change. NP, NP, no change. Here it's net, here it's gross. Pay attention, class. Gross minus depreciation is equals to net. Gross minus depreciation equals to net. That is correct, sir. That is correct, sir. But here we are already in net and you want to reach gross. So you add depreciation that side. So net plus depreciation is gross. So here you will add depreciation. Because you are not going from gross to net. You are going from net to gross. What was the depreciation amount? 20, I believe. So we get 780 as the GNP at FC. The second part is done. Third is NDP at MP, friends. An interesting one then. What is NDP at MP? We just found out what? GNP at FC. I can use this also and I can use GDP at MP also, whichever appears to be closer. Okay. So I want to reach NDP at MP and I have got GDP at MP with me. I want to reach where? NDP at MP. Right? See, I have GDP at MP. I want to reach NDP at MP. So gross is known. We want to reach net. What do? Minus depreciation. So 1000 minus 20 is NDP at MP. That's 980. Game over. So class, I will reiterate for you these three formulas, the top three as I call them. DP plus NFIA is NP, gross minus dep is net, and FP plus NIT is MP. Full stop. Full stop. Full stop. Fantastic, sir. हटाइए इसको. Remove it, sir. Students, having done this much, class having done this much, there is a concept that I want all of us to be clear with. Write down GDP deflator. GDP deflator. Students, it is nominal GDP by real GDP into 100. So what it does is basically, it is the indicator of inflation. Nominal GDP by real GDP into 100. Let me explain. Let me explain. Students, suppose I say, in index numbers you have done it. Suppose base year is year 2015, okay? Suppose base year is 2015. And I say, taking base year 2015, GDP deflator of year 2026 is 130. It means what, sir? It means that any commodity that was selling for approximately 100 rupees in the base year 2015 is now selling at 130 rupees. Is now selling at 130 rupees in 2026. Is selling at 2026. Got it? And remember one thing, class. If the base year you say, base year you are comparing with base year. So for the base year, GDP deflator will be how much? 100. This is what? Nominal GDP by real GDP into 100. Real GDP has been computed taking into account which year's prices? Base year's prices. Which year's prices? Base year's prices. So that's what I'm saying. GDP deflator is nominal GDP by real GDP into 100. So if deflator for 26 is 130, what you need to understand is that GDP deflator for base year is, you should write it down also, GDP deflator for base year is 100. So if for any year you get GDP deflator as 100, it means that year is the base year. Now let me give you a very simple question. Let me give you a very simple question. Suppose I'm talking about year 2026. Okay, I'm talking about year 2026. Let's say nominal GDP is 5,000, real GDP is 3,000. Find deflator. Do it, friends. Do it, friends. Find deflator. So, students, GDP deflator is equals to nominal by real into 100. So 5,000 by 3,000 into 100. 5 by 3 is 1.67 into 100. 167. So GDP deflator is 167. Means if 2015 was base year and prices were around 100 rupees then, currently prices are 167 in 26. Do you know, friends, do you know inflation is computed using GDP deflator? You want to know how? Definitely, sir. Inflation, write down inflation for year 2026. Suppose 2026 is just for example, okay? Inflation for year 2026 is, do you know, deflator of 26 minus deflator of 25 by deflator of 25 into 100 into 100. Game over. Deflator of 26 minus deflator of 25 by deflator of 25 into 100. So class, as I told you, deflator for year 26, how much did we find just now? 167. Let me write down 167 for you of 26. Similarly, you can compute deflator of 25. Suppose deflator of 25 is 140, right? By deflator of 120, 25, yani 140 into 100. This is how inflation is computed in a particular year. This is how inflation is computed. Please tell me the computation, friends. Do it. So it's 27 by 140 into 100. Please do it, class. Yes, 19.28% inflation rate is what I arrived at. So, long story short, if you as a student got confused in this entire picture, I will tell you to stay with two formulas. That's it. Your game is over. That is what GDP deflator is n nominal GDP by real GDP into 100. Formula 1. Now, out of these three, they will give any two. How do I know which one they will give? Second is inflation. That is deflator of year 2 minus deflator of year 1 by deflator of year 1 into 100. We have already written this. Some ICI questions I want us to solve or discuss rather. This one is not needed right now. Just allow me a brief. Just a moment, class. Yes, here we are. So, dear students, have a look of the way we have proceeded with the class. Did we discuss some terms like this, GDP at MP and all? Just remember, GDP at MP is also called nominal GDP. GDP at MP is also called nominal GDP. All of you will get that, right? Real GDP I have already told. And here is your formula. GDP deflator is nominal GDP by real GDP into 100. Correct? And this is the inflation formula. GDP deflator in year 2 by minus 1 by 1 into 100. I have done all this. Now class, a question please. Find out the GDP deflator and interpret it. Surely I can do that. You see, in 2015, nominal GDP and real GDP are same. Yes or no? If they are same, nominal by real into 100. How much is the deflator we are getting? 100. Can you interpret it? That means it is the base year. It is the base year. Same. Say 800 by 650 into 100 and so on and so forth. Keep doing that. And I told you, deflator is an indication of what? Deflator is an indicator of price level. So, say, dear students, 2017 deflator is how much? 136, correct? What does it show, friends? Friends, it shows that a commodity which was selling at 100 in 2014 is selling at 136 in 17. So from 2014 to 17, prices have increased approximately by 36%. Basic reading it. Basic reading it is. Okay, sir, we do get it now. Now another question. I told you we will solve MCQs. The nominal and real GDP of a country in a particular year are 3000 crores and 4700 crores. Okay, so nominal GDP is how much? 3000 crores, and real GDP is how much? 4700 crores. Calculate GDP deflator and comment on the price levels. So students, GDP deflator is nominal GDP, that is 3000, by real GDP, that is 4700 into 100. So it's two zeros gone, 30 by 47 into 100. I think so, 3000 by 47. I think so. 63.82 is what I am getting. It's perfect. So it means that in the base year, if prices were 100, now the prices have indeed reduced. Huh. Remember one more thing, GDP deflator. That is why, class, that is why GDP deflator is also called price index. Is also called price index. In your quantitative aptitude, that is mathematics, in statistical portion, you would have done it in index numbers, right? So whatever it is, find nominal GDP if real GDP is 450 and price index is 120, right? Now, price index is equals to nominal GDP by real GDP into 100. Price index is nominal GDP by real GDP into 100. Now price index is 120. 120. The nominal GDP by real GDP into 100. Find nominal GDP. We don't know nominal GDP. But what is real GDP? We know it's 450 into 100. So that means 120 into 450 by 100 is nominal GDP. Game over. So 0 gone, 0 gone, 0 gone, 0 gone. 12 into 45. 540 apparently is the correct answer. This is nominal GDP. 540 is the nominal GDP. Here you go. I hope all of us are understanding this, friends. Great. Moving on, class. Suppose nominal GNP of a country is given at 600 crores. Write down. Nominal GNP is 600 crores. Price index is given as base year 2020, 10 is 100. Okay. So nominal GNP, we are talking about 2010. And if 2010 is the base year, of course, its price index will be how much? 100. They have given this. Even if they did not give it, we would have assumed that only. Now, now let the GDP increase to 1200 in 2018. Okay. 2018, right? So 2018. Now the nominal GDP is how much? 1200 crores. Okay. And price index is now 110. Of course. Okay. Find out real GDP. So students, nothing doing here. Very simple. Here 2018 they are asking us to compute, right? What is it? Price index equals to nominal by real into 100. Nominal by real into 100. So price index is 110. Nominal is how much? 1200. Real we don't know. Into 100. A very easy thing indeed. So rural goes that side. So it's 1200 by 110 into 100. 0, 0 gone. So 12,000 by 11. Right. So 1090.9 something we are getting. Yes, sir. Sum over? Sum is over? Now, class, all this stuff aggregates I have taught you. Just remember one thing. Institute gives another concept class. In this GDP, GNP, you remember, I had taught you all one thing. In GDP, GNP, I had told you factory price and market price. You remember that? So here is factory price, here is market price. Okay. So this, you know, that factory price plus all net indirect taxes is market price. Yes. What is net indirect tax? All the indirect taxes minus all the subsidies. But here there is another angle in between, which I did not explain. There is a concept of basic price. There is a concept of basic price. Anything at basic price means the factory cost plus there is a one indirect tax called production tax minus production subsidy. So pay attention, class. I will tell you two terms. Let's not get confused. One is production tax, one is product tax. Both are indirect taxes. One is production subsidy, the other is product subsidy. There's a difference. There's a difference. So, students, what is production tax and what is product tax? If I am manufacturing a commodity in my godown, class, if I am manufacturing a commodity in my godown or in my factory, for that manufacture, I have to pay excise duty to the government. For that simple act of manufacture, do you know I have to pay excise duty? Just a second, what happened? Something has happened, maybe. Huh. Just for that simple act of manufacture, I have to pay excise duty to the government. That is production tax. And for manufacture of some essential goods, government gives me subsidy. So If to factory cost, you add not the entire indirect tax, only the production tax minus production subsidy, you get what? Basic price. So basic price is a bridge between factory cost and market price. Ha. Once you arrive at this basic price, now you add GST. GST is not production tax. It is not being charged for manufacture. It is charged on sale. So that's a product tax. It is charged on sale of product. And if some subsidy is returned, then you arrive at market price. So just remember, basic price is the midway. Now, all this we have done already. Now, class, a very important concept indeed. Personal income, personal disposable income, private income. These three areas institute gives questions from. So let me elaborate it for you. I will talk to you about private income first. What income first? Private income first. Think carefully. Listen carefully. Students, private income is a situation which cares about not the national income, which cares about how much private sector has earned. See, there are two kinds of income: factor income and transfer income. I am teaching you all. I am teaching you all. In return, suppose I get money from you. That is factor income because I have done something. In return, I have got this money. I have not got that money for free. But suppose, students, a government official retires, and after retirement, they are getting some money. A government official has retired, and after retirement, they have got some money. Now, this is pension. This is transfer income. Remember, friends, transfer income is not added to national income. Factor income forms a part of national income. Transfer income does not form a part of national income because no new goods and services have been rendered in their return. But when it comes to private income, they don't care about factor or transfer. National income considers only factor income. Look at private income now. It is factor income from NDP accruing to private sector plus NFIA plus national debt interest. Government gives them interest na when the government takes loan from them. That is also added. Current transfer from government and transfers from rest of the world. So in private income, everything is added, even transfer income. Now we talk about what class? Now we talk about personal income. What is personal income? Personal income is the income that an individual person gets. What do they get? First, you start from national income. First, you start from national income. From national income, you deduct undistributed profits. You know why? Private sector has earned this profit. Who has earned this profit? Private sector has earned this profit. Private sector has earned this profit. But has the private sector distributed them? No. Will it reach the individual persons? No. Because private sector is saving them. So once you arrive at national income, that is your NNP at FC. Once you arrive at national income, that is your NNP at FC, class, you will deduct undistributed profits. What will you deduct? Undistributed profits. That is reserves. You will deduct net interest payment made by households. You know why? Because if I have to pay interest on some loan, that is not a part of my income. That is to be compulsorily paid by me. I will deduct corporate tax from national income. Why? Because corporate tax is reaching the government, not the private individuals. We are computing personal income here. Money should reach the hands of people. Money should reach the hands of households. Plus transfer payment made to household from firms and government. So personal income is nothing but the income of the households. Money that reaches the hands of the households, money that at least reaches the hands of the households. That is personal income, my dear students. And what is personal disposable income? Students, even the households have to pay personal income tax, and they have to make other payments like some license fees, some penalty they have to pay. These are non-tax payments. So we have discussed all of these rights. Let's go ahead, solve this. Let's see whether we are able to understand. First one skip for now. Second one we will do. Let's see. From the following data, estimate national income and personal income. A good question. Let's see. You have to note down the key information, not the entire question. What information has been given to you? Check. NNP at MP 1891. NNP at MP is 1891. Acha, they have to compute NNP at FC. So from NNP at MP, class, whatever is given, you put it on the left, and wherever you want to reach, you put it on the right. You want to reach NNP at FC. So how do you calculate national income? From market price to reach factory price, from market price to reach factory price, what do? We deduct net indirect taxes, isn't it? Just find out net indirect taxes. You see, it's very easily available. This is 1891 crores. I have written 1891. This is indirect taxes 175. This is subsidy 30. So how much are you getting? Tell me. 145. 145. So class, if you are deducting 145, you are getting an NP at FC. So 1891 minus 145. How much is it, friends? How much is it, friends? 189 1891 minus 145. It's 1746. Game over. National income you have got. Now, now comes the interesting area. You have to compute personal income. What will be personal income? In national income, you will deduct all those incomes. From national income, you will deduct all those incomes which does not reach the household. And you will add all those transfer incomes which reaches the households, because transfer incomes are not included in national income, but they are reaching the households. Personal income cares about where they reach the hands of the household or not. They don't care about whether households have worked for it or not. They don't care about such bifurcacies, right? So see, 1746 correct. Now, personal income. Look carefully how we have deployed. National income, we start from national income. Minus, you look. Income from property and entrepreneurship accruing to who? Government departments. If it is the government's income, will it reach the households? I don't think so. So you deduct that. Minus 45. Next, savings. Did I not say retained earnings are to be deducted? Retained earnings are to be deducted. You see, retained earnings are deducted. But class, tell me something. Interest on national debt. Basically, what happens is government borrows, so government allows interest on that. It is an income, it should be added. It is not added in national income, so interest on national debt will be added. I told you, whatever reaches, add, whatever does not, less. See, current transfers from government means households are getting pension. So they are getting it, yes or no? Yes, add. From rest of the world, households are receiving gifts or something. Add that. Add that. Savings of private sector. Is the savings reaching the households? No. Deduct that. Deduct that. Is the corporate tax reaching the households? Who is getting the tax? Government. Remove that. Bus, game over. That's personal income for you. That's personal income for you, friends. Done, sir. Personal income done, sir. Yes. Here we have it, class. I will request every student to do this one. Calculate the aggregate value of depreciation. Wow. They have given us to compute depreciation. Where GDP at MP, we know GDP at MP is how much? 1100 crores. Net factor income from positive hai. From means positive hai. NFIA is 100 crores. Value of indirect tax minus subsidy. So net indirect tax is 150 crores. And national income is 850 crores. So NNP at FC is 850 crores. NNP at FC is 850 crores. Now solve it, class. You have to compute depreciation. Compute depreciation. See, students, a very simple thing indeed. From GDP at MP, NNP at FC we have to reach, okay? We know the value of both. So let me put GDP at MP here. Let me put NNP at FC on the right. Okay, okay. Let me frame a model first. This is gross. I want to reach a net. So from gross to reach a net, what do we do? Deduct depreciation. This is domestic product. We want to reach a national product. What do we do? Add NFIA. This is market price. We want to reach factory price. What do? We deduct net indirect taxes. So the missing figure you will get very simple. GDP at MP is how much? 1100. Put 1100 here. Minus depreciation is X plus NFIA is 100 minus net indirect taxes is 150 equals to NNP at FC is how much? 850. Game over. Now class, a very simple thing. All of this is brought here plus 100 minus 150 minus 850 and minus x goes this side, that is x. So x is equals to 1200 minus 1000. It's how much? 200. Game over. Depreciation is 200 crores. Next one. A good question. We have to compute what here, class? We have to compute NNP at MP and personal disposable income. Since they have given personal disposable income, you will also have to calculate personal income, because from personal income only you deduct personal income tax and personal payments so that you arrive at personal disposable income. Yes or no? So your target one should be NNP at MP, target number one. Target two should be personal income. Target three should be personal disposable income. Fire. Attack, class. Students, we will solve it. Yes, and to arrive at personal income, you also have to reach national income, right? Because all computations are done there from. Okay, now NNP at MP you want, the first step in the procedure. So see, students, NDP at FC we know, we want NNP at MP. NDP at FC we know, we want to reach NNP at MP. Okay, now it's very easy. See, this is net, this is net, this is domestic product, this is national product. What do? You add NFIA. Now, this is factory cost, this is market price. How do you reach? Add net indirect taxes. So, to reach NNP at MP, here is NNP at MP. First, we have NDP at FC, which is 4900 plus NFIA, net factor income from abroad, which is 80 plus net indirect taxes. Now, see, this is indirect taxes 335, this is subsidy 262. So, net indirect taxes is 335 minus 262. 335 minus 262. So, class, we get 73. So, we arrive here, and therefore, NNP at MP, my dear students, we arrive at 14980 plus 73. You know how much are you getting? 15053 is what you are getting. Game over. So 15053 is my first step in the procedure. 15053. Here is my answer. NNP at MP. Now I need to arrive at to cover my journey or carry forward my journey of computing disposable personal income. I need to reach the station of national income first. So let's find out national income. See, this is NNP at MP. It's rather easy that to reach NNP at FC. See, factory cost plus net indirect taxes is market price. So market price minus net indirect taxes is factory price. So minus net indirect taxes. Acha, we did it na? 73 I think I got. So 73 is gone. How much are we getting? 14,980 is your national income apparently. This is just the beginning. This is the beginning. So national income is 4980. Of course, when institute gives such questions, it will divide it into 3 to 4 parts. But as a teacher, what I can do is ensure you know how to solve it. This is what I'm doing here. National income is 14,980. Okay, I just have this recorded. Now my target is personal income. Okay, not personal disposable income. That's not my target. So here it is. Income from domestic product accruing to who? Government. Will it be added? No. Remove 150. Because it is accruing to government. It is accruing to government. It's not our case. We remove that. Interest on national debt. Add them. Transfer payment by government. Add it. Private donation from abroad. Add it. NFIA nothing doing. Direct tax for the time being nothing doing. Taxes on corporate profits. Will it reach us? It won't reach us, right? Remove it. Undistributed profit, savings. Will it reach? No, remove savings. So students, when you do all this, you get personal income. Please tell me how much is it? When you do all this, you get personal income. Tell me how much is it? Students, 14763 is what most of you should get. Personal income. You understand the logic, na? You add what you get, you reduct what you don't. Game over. Now, from personal income, people have to pay direct taxes, personal taxes, right? Households have to pay that. So you remove that 100, you get 14,663. That is your disposable income. Next class, circular flow model. What is the concept of this circular flow? Students, it is a cycle. I will teach you this cycle now. Students, see carefully, okay? Listen to me very carefully. Students, I am teaching you all. This is production, service. Sir is teaching. Okay, sir is teaching. Sir is teaching. Because sir is teaching, sir will get some income. I will get some income. The income that I get, what will I do? I will keep that income or I will spend. I also need to, eat, sleep, etc. So I will need a house, I'll need proper clothes, etc. So expenditure and the cycle continues. This is circular flow of income. It has how many stages as is witnessed by you? Three: production stage, distribution stage, and consumption or disposition stage. Production, distribution, or consumption, PDC. Production, distribution, consumption, PDC. Production, distribution, and consumption. Now let me read this for you. What is circular flow of income? Students, it refers to the continuous circulation of production, income generation, and expenditure in different sectors of the economy, within different sectors of the economy. Continuous flow of production, income generation, and expenditure. Okay, you can also remember it like this: PIE stage, PIE, production, income, and expenditure. The PIE, involving different sectors of the economy. There are three different interlinked phases in the circular flow, which we have discussed already. Now, students, if it comes to measurement of national income, friends, to measure national income, there are how many methods? Three methods are there. First is the value added method, VAM, or output method or product method. Second is the IM, income method, and the last one is the AIM, expenditure method. There are three different methods to do so. I will first of all be talking to you about value added method or product method. First of all, I'll be talking to you about value added method or product method. What is value added method or product method? See, product method is a situation where we find national income by adding the value added at each stage. Sir, nahi samajh aaya. Try and understand. Try and understand. I am a bread maker. Okay? In my factory, I make bread. I buy flour. Bread needs flour. Suppose I buy flour worth rupees 10. The person from whom I buy this flour is stage 1. They sell me flour worth rupees 10. This flour for me is a raw material. I add some ingredients and I sell the bread at rupees 40. Try to understand, there is a double counting in 40. 40 rupees includes 10 rupees flour also. You remove that. So how much value did I add? 30. So 10 rupee value was added by stage 1. 30 rupees value was added by stage 2. So total national income generated is 10 plus 30. That's 40. So you can either add the value at each stage, or you can just take the value of the final goods and, goods and services. The bread was selling at 40. It includes all the stages. You are getting 40 only. This is what the value added method tells us. For value added method, you have to compute value of each sector, value added of each sector. How many sectors are there in the economy? Three: primary sector, secondary sector, and service or tertiary sector. For computing value added of any stage, you need to do one thing only. Value added at any stage. You can write it down, class. GVA at MP. Value added by any sector. You all can write it down, class. Value added by any sector at any stage is value of output minus input. That is intermediate consumption. Value of output minus input. That is intermediate consumption. Now, class, how do you arrive at value of output? Students, value of output is sales plus closing stock minus opening stock minus intermediate consumption minus intermediate consumption. So that's what I'm saying. Value of output is sales plus closing stock minus opening stock. Got it, sir. So, dears, you have got it. Value of output is sales plus change in stock minus intermediate consumption. Definitely, you get that. Okay. Sir, do you know that if you add for each sector, it is GVA at MP? You can write it, class. This is for primary sector. You add GVA of at MP of secondary sector and you add GVA at MP of tertiary sector. When you add the GVA of each sector, how much, where do you arrive? GDP at MP. And the entire class knows that's that once you reach GDP at MP, entire class knows that once you reach GDP at MP, entire class knows that once you reach GDP at MP, GDP at MP, from GDP at MP to reach national income, that is NNP at FC, this is gross, this is net. Here you deduct depreciation. This is DP, this is NP, add NFIA. This is MP, this is FC, less net indirect taxes. Game over. You arrive at NNP at FC. You arrive at NNP at FC. Sum is done. Class, the sum is done. You arrive at GDP at MP minus DEP plus NFIA minus NIT. And you arrive at NNP at FC. So remember, this was the value added method. Yes, you should remember that imputed rent of owner occupied houses will be included. What will not be considered is second hand goods. Remember, in this world, what is not counted? Second hand goods. Why? Because the year in which these goods were made, they were already included that year. So second hand goods buying and selling is not a part of national income because no new goods and services are being produced. No new goods and services are being produced. With this, students, with value added method, I leave you in today's class. See you all in the next class where we are going to discuss what? Income, expenditure method, some numericals, and Keynesian economics. That's it. Goodbye, everyone. Yes.